welcome to Finance and Footnotes. Today is Tuesday, July 11th, and I'm your co-host Brent, joined with my friend and co-host Zach. Zach, how are things there on the East Coast?
Pretty good, man. Sunny today. Got a baby coming this week, so we'll see how that goes. But any day, I might have to leave. I don't know.
Well, we'll totally understand, and hopefully our viewers do as well. You got to prioritize. That's what life's about, right? So pre-congratulations, man. Please keep us posted.
Thank you.
That being said, because I feel like we're on a timeline, let's just jump right into it. Who knows? Who knows what's going to happen? I think in general, what we're going to talk about today, taking a step back, right? What you and I are trying to do here for folks is try to give them some notes that they can take value from, right? Try to dig through some minutia, go a couple layers deeper than most people would, and try to give them some actionable items, right? So we put together some charts and some notes today. Today, I'm going to talk a little bit about what I'm getting asked most from clients, which is what's going to happen in the second half of the year. So I've got a couple of notes on that. I'd love your feedback on that. I'm also going to talk a little bit about inflation. I saw that was something you wanted to talk about. And then finally, I want to talk about one of the three major components or variables I think that affect market prices. Taking a further step back, there are dozens and dozens of known and unknown variables that affect the marketplace. But I think in general, there are three major ones, one of them being what the Federal Reserve is doing, of course, corporate earnings, which we're going to get a start of this week, and then finally sentiment. So I want to spend a little bit of time talking about my favorite indicator, sentiment. What do you have on the docket for today, my friend?
Excellent. I'm going to follow up a little bit on a couple of things we talked about last week when we did, the this is not that type of situations, looking at prior recessions, and we looked more on the technical charting side of things. I want to show a little bit more of the fundamental economic indicators when it comes to that. And then also look at a few risks, a couple indicators out there that, could be a little bit concerning, but let's dive into your second half chart here.
Great, thanks. So let's get started. This is actually a chart from LPL Research, and it's titled "The Second Half," and it's pretty interesting, right? These charts look very important. We talked about this on an ongoing basis. Sometimes they look more important than they are, and I think this might be the case here. But what we're looking at here, the 10 previous times since 1950 that the stock market, the last 6 months that we had, the first half of 2023, was correlated, the 10 most correlated times over the last 70 plus years. So you can see here, LPL Research went back and did a statistical correlation analysis and found that if you look back, 9 of those 10 times had a positive outcome, which is impressive, and the median return was 12.1%. I think what this speaks to, firstly, is that there's some momentum. I think that's an important part when we look at what's going in the marketplace. Things were so negative to start the year. There's still some dispersion. I'm going to talk about that in a second. But Zach, what do you make of this? Is it worthwhile? Is it reason enough to maybe be a little optimistic?
Absolutely. And I think it's important to note too that 1 of 10 times where it wasn't up, the market was up 39% in the first half of the year and still finished with 31%.
That was, I'm looking back here, that was the best first half of those.
Right.
Of those
yeah.
10
So certainly
periods.
certainly wasn't a bad year. And I do think that momentum, it's not even, I think that it is one of the recognized anomalies in the market. That momentum, that prices do tend to continue on the trajectory that they have been on. So momentum certainly is something that you take into consideration. And as this shows, when you do have strong first halves, you do tend to have strong second halves.
Yeah, I think that's my takeaway. You can't. There's never anything that's black and white or perfect. But I think it's lining up for a more optimistic second half than we might otherwise have. Okay, so that's the first note I wanted to make. There's some reasons to be optimistic here as we look into the second half of the year, just from a momentum perspective. So let's move ahead now to the inflation conversation. We're going to get some big numbers this week about what's going to happen. We're on the right trajectory, but I was looking at the pre-notes here, Zach, and I saw that your charts are much more impressive than mine. So I'm just going to skip right forward, right through my inflation. I'm going to hand this hot potato off to you and skip right ahead to your charts.
Sure, we could do that. And I really like this one from JP Morgan. This is from their Guide to the Markets chart that they put out each quarter. And it really breaks down the components of both headline CPI inflation and the core services ex shelter CPI inflation numbers. And that second one is one that the Federal Reserve watches closely. So if you see on the left-hand side, you look at the headline CPI, that's been falling precipitously since the peak back in the summer of 22 from 9.1%. The latest reading was 4.0%. And even when you take that into consideration, over 2% of that 4% was shelter. And shelter is the most lagging of these indicators. It takes a while for the increases that we feel kind of in the everyday economy to filter through to these CPI numbers when it comes to shelter, as rents are renewed, as people, people renew their leases and things like that. So we do expect that that's going to level off and start to decline going into the second half of the year and into 2024. So we continue to expect headline CPI to fall from 4% closer to their target of 2% over the next 6 to 12 months. And on the right-hand side, it's been more sticky. So you do see that it didn't get quite as high. It only got to 6.6% at the peak, but has only come down really to 5% and has been pretty sticky the last couple of readings. But look at what the components are. Most of that in the last month or 2 months has been transportation services ex airfares, which is essentially motor.
It's a mouthful,
repairs.
Is what it is.
It's a mouthful. Motor vehicle repairs, think car insurance, things of that nature. That again takes a while to kind of filter through to the numbers, especially when it comes to insurance, because those are generally only renewed annually. So again, we think that while it has been sticky, if you look at that other services, and if you look at the the energy component of the whole headline CPI, has really started to compress, and we think that's going to continue.
I think we have to put a magnifying glass on this, over the next 6 and 12 months. I read an interesting article in the journal this morning that was talking about deflation in China. China.
Absolutely. And deflation is a
quick
risk.
distinction? Could you give us the distinction for those?
Yeah, absolutely. Obviously, inflation is the increase in prices and goods and services throughout the economy, and deflation is a decrease in prices of goods and services throughout the economy. And some
what
folks
about
may
disinflation?
think, and disinflation is inflation that is declining at a lower rate. So we're kind of in disinflation, right? So it's going from 5 to 4 to 3, right? That's disinflation. Deflation is when it goes negative, and the thing that you're buying today is going to be cheaper 6 months from now. And that's actually bad. That's actually worse than inflation, because that really slows down economic activity. If you think that that thing or that service that I'm going to buy today is going to be cheaper in 6 months, you're just not going to do it. You're going to wait, right? And so deflationary spirals are actually really bad for economies. So you don't want deflation, right?
And rare. So we're hoping it doesn't happen.
Yes.
We don't expect it to happen. I just to try to put you off on a tangent there, but I think it's easy to get caught in the minutiae about disinflation, deflation, inflation, et cetera. But to your point, the article that I breezed through on my side of inflation, just those graphs taken from the Wall Street Journal this weekend. Looks like the major drops are, like you mentioned, are coming from rental prices and from used car prices are finally dropping. Really sticky, really lagging. So, things can continue on this trajectory through the rest of the year.
Yeah, absolutely. And it does introduce that risk, though, that they've gone too far and that they are using this lagging CPI indicator to make decisions today to say that we need to continue raising rates. And that could potentially tip us into a situation where inflation kind of falls through their target, goes beyond their 2% target, and perhaps into deflation. So that is the risk to the downside of what the Federal Reserve is doing, and hopefully they are aware of that. And
assuming they are, but we'll get some notes on that.
The history of the Federal Reserve is that they go too far, they wait too long to start, and they go too far. That's the history, right? They tend to overshoot on both sides of it. So they don't have history on their side with their decision making.
So we'll have to wait and see how that plays out. We are currently in a quote unquote pause, right? With possible quarter point increases coming later this year. So we'll report on that in weeks to come. Suffice to say, inflation is an important aspect of this puzzle, and of course, federal response to that as well. So I'll put a pin in that and I'll move to my last series of charts, which does include a great quote, so stay tuned. But I want to take a pause here and I want to move over to the sentiment, which again, I mentioned is one of my favorite indicators. I think the basic 30,000 foot level, if everyone's doing one thing, if everyone is bullish, if every last dollar is invested in the market, boy, it's going to be really hard for that market to go up again, right? And it could go the other way. So there's this sentiment momentum. And I want to take a look here at the market sentiment. This is published by Citigroup. It's their panic euphoria model. It's published in Barron's several times a month. I love this. I've been watching it for over 10 years, and it's surprising to me how it's often right. Now, there was a lot of distortion during COVID, but what it's essentially doing, and I have a couple of green arrows here for you to kind of pinpoint, because you can't really see it here on the screenshot that I took. But anything that's above 0.4, that's the top green arrow, is considered euphoric, and that's typically bad. For momentum, people are in a euphoric state of mind. All that money's already been invested. It's time to watch out for a bottom in the market. But the opposite holds true. So if it's at -4 or lower, -2, -0.2 or lower, that's the lower green arrow. That's a very pessimistic, and that would suggest that over the next 12 months, you could see a significant rise in asset prices. And you can see in the fine print at the bottom of that chart that there's a 95% historical likelihood going forward that if you're in a panic state, which is -0.2 or greater, the next 12 months will be positive for stocks. But the opposite is true as well if you're in that euphoric state. So I wanted to point this out because I think it's kind of contradictory. If you look over the last 12 months, things have been very pessimistic. People were thinking about the debt crisis, inflation, everything you turn on the news for the most part is very negative, and that plays into the cycle. But if you look over the last month, boy, there's been a big turnaround. And this is one of the biggest turnarounds I've seen in the last several years. So it's not near that euphoric state, but boy, it's a big indication that things are people getting more optimistic. Did you see the small business survey yesterday? Yeah, people are, business owners, consumers, they're positive. People are getting optimistic, I think.
Yeah, big change from the readings of the past year, kind of across these various sentiment surveys. And there's different ones. I do like the Citigroup panic euphoria model because it kind of puts it into a pretty concise, easy to read chart. Some of these sentiment indicators are a little bit harder to digest, but this one does a great job, and it does have the pretty fantastic correlation numbers about when you are in that panic mode or euphoric mode, that it does tend to kind of signal the opposite of what the wisdom of the crowds are doing. So, we've been climbing that wall of worry for much of the last year, since the lows in October. And it's not surprising, when you kind of have everyone positioned a certain way, there's only so many more trades and so many more dollars that can pile on to that position. So it kind of makes sense that it will turn around. And it is interesting because it's kind of the opposite of momentum, right? It's like, well, if momentum's an indicator that says things are going to continue the way they have been going, but this is saying that, it's going to switch based off of what it has been doing. It's a little bit interesting, but this is more of psychology. The momentum indicator is more of price action, what's actually happening in prices in the economy.
So just a big step back. This is one of my favorite indicators. It's not often cited, I think, in the financial press. I don't see it anywhere other than Barron's. It's actually kind of hard to find in a Google search, but it's something that we'll be coming back to time and again over as this indicator changes. Right now, we're kind of at a neutral stage, but I just wanted to make note of it and kind of introduce it as we move forward. So
absolutely, and often it is neutral, right? A lot of times it is neutral. I think a lot of the last year we've been in that kind of panic stage just with kind of everything that's been going on, but a significant portion of the time we are in that neutral area.
Exactly. So this, again, take a step back, this market sentiment Citigroup panic euphoria model is suggesting things look pretty good coming in the next 10 to 12 months, right? If it were a standalone indicator. So that being said, on the one hand, looks positive. I want to introduce something on the other hand, right? So here is, this is a tweet from Seth Golden on Saturday. And you're citing some interesting data. I'm not sure if you saw this, Zach, but I thought it was really interesting. Over the last 25 years, there have been 4 times that Wall Street was net negative. So in a nutshell, net negative is folks that are putting the money down on a bullish, positive, or bearish negative sentiment, right? So just adding those two together, if it's net positive, more people are bullish. If it's net negative, et cetera. It doesn't happen that often, but if you look, going forward in the next 6 months, we actually have a net negative in the second half of the year. The last 4 times it happened, stocks moved meaningfully higher, with an average somewhere over 10%. It's a very small sample size, but I thought it was worth noting. So you have, on the one side, you've got folks that are, becoming more optimistic, but Wall Street, that's very negative. And I think it looks like we should be aware of this going forward. And it leads me to my quote, which I promised you, which is from Harry Truman. Give me a one-armed economist. On the one arm, you've got sentiment, business sentiment, small business owners. You've got consumers that are improving, and on the other hand, you've got Wall Street that's ultra negative. Amongst the top 5 most negative times in the last 25 years. So, with that said, those are the points that I wanted to make today. Zach, turning it over to you. Where do you want to start?
Yeah, that's a great quote. Economists and market prognosticators, even such as ourselves, are notoriously couching our predictions and hedging our statements. But
there's another one too. It's like if you lock 10 economists in a room, you get 12 opinions or something.
Yeah, I like it. So I wanted to jump to the rosy expectations that analysts are predicting in, and interesting because this is kind of the see-through to your sentiment chart, your positioning by Wall Street, is that yes, they do predict that the next 6 months will be fairly negative. But if you look at consensus analyst estimates going out into 2024, 25, and 26, we see those earnings estimates pick back up in a big way and really resume that significant upward trajectory that we've had much of the last decade. And I think that this is a potential risk. It is amazing, but it's a potential risk to the downside that it's a pretty high bar to clear, right? And if these numbers are not met, if we don't have this very quick earnings recession, really just 1 year or 2 quarters worth where earnings do decline and then don't pick right back up, I think that what the market is doing right now is seeing through to this, right? So we're getting this increase right now where it's basically saying that everything in 2024, we're going to be back to kind of, pre-2022 earnings numbers. And that's a high bar to jump over. So I think that is a potential risk to the downside. I mean, you see that 2026 number at $275 of S&P 500 earnings. That's significant considering in 2019, it was just barely over 200. That's a lot of growth in just a couple of years in a potentially weakening economy. So I just think that's something to keep an eye on, is like, what are these estimates going to do as we progress through earnings season here in the second quarter? What are companies going to start guiding? Because we're going to start getting guidance for 2024 pretty soon. So I think that's something to keep an eye on.
Yes, and it definitely plays into that valuation conversation we had last week. That's the numerator in that price earnings ratio, and it's priced in, like you said. So yeah, great point to be aware of. We'll be focusing on that, of course, going forward.
Yeah, absolutely. And if you say, if you're looking at it today, it's kind of that same thing where, we were talking about whether you can disagree on valuations. Well, absolutely. If you think that, what are your 2025, 2026 earnings going to look like, right? Then if it looks like this chart, then your current valuations look pretty good. If these earnings don't come in like that, then it looks pretty rich. So I think it's an interesting thing that many people may not be aware of, that these estimates are kind of baked in. This next one is from Ned Davis Research. I think they do really great stuff. They put together some pretty complex correlations between things. This one's it's a busy chart. There's a lot going on here. Essentially what you see is the yellow dotted line is going to be your 10-year forward returns. So you see the blue line goes farther out in time. The yellow line is 10 years lagged, essentially. The blue line is essentially equity as a percentage of total household equities, bonds, and cash. How much of your household investments is allocated towards equities as opposed to bonds and cash? It kind of makes sense that it's almost the same thing as wisdom of the crowds, right? As equities become a higher and higher proportion of household investments, it's kind of the opposite thing happens. That tends to not be a great time to invest. And vice versa, as that ratio gets lower, tends to be a very good time to invest. This relationship has decoupled in the last few years here. And if you take it at face value, now I do think that there's things that have changed in the market with the interest rate regime. This does go back to 1951. It's a long history. So obviously the market's very different. The interest rate environment is very different. The monetary environment is very different. So you don't necessarily want to compare these very different time periods. But if you do look at it and take it at face value, it implies essentially a zero return for the next decade. That's kind of what this says. If you take this indicator, which going back to 1951 has an 85% correlation. It's a pretty strong relationship between these two. So I think it's just something to keep in mind. Vanguard puts out their 10-year annual return expected numbers, growth stocks, low single digits, international is a little bit higher. But so I just think we do need to be as financial planners, and when we're running scenarios for our clients, when they're doing income projections, retirement projections, things of that nature, to perhaps have the conversation with a more conservative return expectation, rather than just saying, hey, equities return 8 to 10% a year, and just factoring that into your simulations, perhaps seeing what it looks like if you do only get 3 or 4%. Are you still on track for your goals? Do you still meet those retirement dates? And
I love the Vanguard point you bring in. The point that I wanted to make is that this is a busy chart, but this is what, it's like you're a CFA. Like, that's essentially my opinion. I'm a CFP. I've got about 20 years experience. I don't like to admit that. In my experience, when I run across CFA, it's basically a PhD in finance, and you at that point call it finance because you've spent the energy to get there. So I think if you run across an advisor who's saying, just 8% expected returns over the next 10 years for equities, I think they're lazy. I'm sorry to say it. Like, it's not a carte blanche, statement, but at the end of the day, there are some indicators. Vanguard is one of the few houses that's, willing and able to make a 10-year prediction, because 10-year predictions don't often pan out. But their data, it looks to subdued returns. And I think it's a great point that we need to look for alternatives that can, look to maybe add some alpha over time.
Yeah, absolutely. And it really just comes back to those planning conversations and just having that discussion and including it in the models. And, in a lot of these financial planning software models, you can, toggle the return expectations or inflation expectations or tax rates and things of that nature. And I think it makes sense to just have that discussion with clients to show, what does it look like if we only get 3% annualized? What does it look like if we get 0% annualized over the next 10 years, which essentially was the 2000 to 2010 decade, right? So it's not like it hasn't happened before in recent memory. So it could happen again. So I just think it's something to point out, something to be aware of. But like I said, these types of things it could decouple permanently, because the market and the economy is very different than it was in the 1960s, right? So it's perhaps not necessarily a valid indicator anymore, but I think it just makes sense to at least be aware of it when something is this strong for this long.
Yeah. Well, to put it on the microscope is a good idea. So talk to me about economic leverage.
Yeah. So these next two are two sides of the same coin. One is household economic leverage. The other is financial system economic leverage. And this just follows up on what we were talking about last week with kind of this is not that. And the first one, where you're looking at U.S. household leverage, it's essentially the household debt to equity ratio, liabilities to net wealth of households. And you see that it is at lows that we haven't seen since the 80s. And it is nowhere near what it was prior to.
It's amazing. No one is talking about this. I haven't seen this in the press in the last 6 months.
Yeah. So it just means households are in a much better position than they were leading up to the last financial crisis. Now, there is some distortion in this because it's an average. I looked for the median to see if I could find a chart for the median. I couldn't find it. But so this is kind of pulled up by some of the wealthiest households. There has been, especially since COVID, a bit of a wealth transfer from the poor to the rich. So the wealthiest households have gotten much wealthier. So that is pulling this ratio down a little bit. But essentially, folks' home values are high, their liabilities are relatively low, and that puts them just in a better position to weather any potential storms. And where we were in 2006, 2007, 2008 was in a much different position. And the same goes for the banks. And this one's even more of a marked, difference, where if you essentially look at right before the financial crisis, banks had $23 of deposits for every dollar of cash they actually had. So it was essentially a 23x leverage in the financial system. When that goes in the opposite direction, that can really evaporate available equity quickly. And you can see now that after Dodd-Frank and after all the capital regulations that have been put in place post Great Financial Crisis, this is tightly regulated. So banks cannot get to that 23x ratio anymore. So the financial leverage in the system is just much, much lower than it was leading up to that last financial crisis, and the same thing on households. So overall, everything in the economy, I think, is just in a better position to withstand a storm. And I think it's important to know.
Yeah, the half-life of that financial crisis, right? I mean, there's evidence, right? If you look back in the Great Depression, people born in that era, they never emotionally recovered. Their ability to invest never recovered. And I think that half-life of the financial crisis, although it was over 10 years ago, I think it's still with most investors today and affecting their moods and their sentiment.
Absolutely. Yeah, it affects their, especially for folks in our industry who are in our age group that kind of came of age during the financial crisis. I started my career in 2007. So that was like the first memory that I had as a money manager. And I think there's a lot of folks who are in a similar position that just have that experience kind of etched into their minds. And I just think those cumulative decisions across the economy and across, wealth management and across banking have an effect that there's a memory of that. And coupled with tight regulation, where things can't get that way when it comes to the financial economy, I think just have led to this result where we're just much less levered.
Yeah. Taking a step back then to summarize our conversation, we started with some charts talking about what could happen in the second half of the year. If you stuck a camera in my face and published it on YouTube, I think I would probably say things look pretty good in the second half, right? I mean, typically, years are up maybe almost 70% of the time. I think the next 6 months probably looks more likely that it'll be up than the average outcome. I think sentiment is dispersion. I don't think there's actually a great consensus on what's going to happen going forward, which I think is a good thing. If everyone's on piled on one side of the ship, my ear goes to the ground and I get very concerned. And then inflation, will have to wait and see kind of what happened. But the last point, I guess, summarizing your final two slides here on economic leverage, it's impossible to predict a black swan event. That's not the purpose of this podcast. If anyone's talking about it, good for them. It's nearly impossible. But I think it seems like if there is something that comes down the road, whether it's tomorrow or 10 years down the road, it seems like we're in a much more stable position financially as a nation and individuals to withstand the storm.
Agreed.
Awesome. Well, anything else to add, my friend, or you want to sign off?
Well, that's it, man. Let's go. Let's see if we can get this baby delivered.
Well, good luck on that, my friend. I guess we'll have to wait and see when the next time he's available. As always, if you have any questions, please.
I'll bring the mic. We'll bring it into the next podcast is from the delivery room. I'm sure my wife will be thrilled with that.
Or just have the baby with you. I think that'll definitely improve numbers.
Definitely, for sure.
All right, Zach. Well, thanks for your time. We'll talk to you soon.